Good evening, everyone, and welcome back. Today, we are discussing one of the most important topics shaping not only the United States economy, but the entire world economy, the U.S. stock market and oil prices. These two powerful forces often move global markets, influence inflation, affect household budgets, and shape investor confidence. When Wall Street rises or falls, and when oil prices jump or crash, millions of people feel the impact. So let's break this down in detail. The U.S. stock market remains the largest and most influential financial market in the world. It includes famous indexes such as the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. These indexes represent some of the biggest companies in America: technology giants, banks, healthcare firms, industrial companies, and energy producers. When investors feel confident about economic growth, company profits, and lower inflation, stock markets usually rise. But when uncertainty increases, such as recession fears, war tensions, interest rate hikes, or weak earnings reports, markets often decline. Recently, U.S. markets have shown mixed signals. Some sectors, especially technology and artificial intelligence companies, have performed strongly. Investors continue to believe that AI will transform industries and create long-term profits. Companies linked to cloud computing, semiconductors, automation, and digital services have attracted major investment. At the same time, traditional sectors such as banking, transportation, and retail are facing pressure from high borrowing costs and changing consumer spending habits. Now let's talk about one of the biggest factors influencing the stock market: interest rates. The USA Federal Reserve plays a key role in market direction. When inflation rises too quickly, the Federal Reserve increases interest rates to slow the economy higher. Interest rates slow the economy higher. Interest rates make borrowing more expensive for business and consumers. That can reduce spending, slow company growth, and lower stock prices. On the other hand, if inflation cools and the Fed starts cutting rates, markets usually react positively because cheaper money supports growth. This is why investors closely watch every speech and decision from the Federal Reserve. Now, let's shift to oil prices. Oil remains one of the most strategic commodities in the world. Even with the rise of renewable energy, oil still powers transportation, manufacturing, aviation, shipping, and many industrial sectors. When oil prices rise sharply, costs increase across the economy. Gasoline becomes more expensive. Shipping costs rise, airplane expenses increase, manufacturing becomes more costly, and this can lead to inflation. When oil prices fall, consumers often benefit through lower fuel costs, but oil-producing companies may suffer. So what moves oil prices? There are several major factors. First, global demand. If the world economy is growing strongly, countries use more fuel for factories, transport, and travel. That pushes oil prices higher. If economic growth slows, demand weakens and prices can fall. Second, supply. Major producer like the United States, Saudi Arabia, and other OPEC nations heavily influence supply levels. If producers cut output, prices often rise. If the production increases significantly, prices may fall. Third, geopolitical tensions, conflicts in the Middle East. Sanctions or threats to shipping routes can create fear in markets and push prices higher very quickly. This is because traders worry about supply disruptions. Now let's talk about America's role. The United States has become one of the world's top oil producers thanks to shale production. This gives America more energy strength than in previous decades. Higher oil prices can benefit us. Energy companies increase drilling activity and create jobs in oil-producing states. However, expensive gasoline can hurt consumers and reduce spending in other parts of the economy, so oil prices can be both positive and negative depending on where you look. Now let's connect oil prices with the stock market. When oil rises moderately because of strong demand, markets may see it as a sign of healthy economic growth. But if oil rises too fast because of war or supply shocks, investors worry about inflation and slowing growth. That can pressure stocks. Energy company shares may rise, while airlines, transportation, and consumer companies may fall. This creates sector rotation inside the stock market. Another important issue is investor psychology.